Hello, guys. Welcome to our accounting workshop. I'm Dinu.
And I'm Ananya.
We're part of the communications team at Next Up Business, a nonprofit organization committed to bringing essential business knowledge to the next generation of leaders. I overlook Boost, a program that produces videos like this one to help young professionals. Today's session is all about a rapidly growing field in business, accounting. From automated financial reporting to analyzing big data, we'll explore how companies leverage these tools to enhance accuracy, streamline operations, and make informed financial decisions that shape their strategies and success. Before we dive into the specifics of accounting, let's take a look at what we'll be covering in today's session. Having a clear roadmap will help us stay organized as we explore the fundamentals of financial reporting and analysis. We'll start with the balance sheet, which is one of the key financial statements used by businesses to analyze their financial position at a given time. This statement provides a snapshot of a company's assets, liabilities, and equity, helping stakeholders understand what the business owns, what it owes, and how much value belongs to its owners.
Next, we'll break down an example of a balance sheet to see how businesses structure this essential financial report. Understanding the layout and components of a balance sheet is crucial for interpreting financial data accurately. After that, we'll move on to income statements, another fundamental document. The income statement, also known as a profit and loss statement, provides insights into a company's revenues, expenses, and profitability. It essentially tells the story of how a business is performing financially, detailing whether it's making a profit or operating at a loss.
Following the income statement, we'll discuss cash flows, which track the movement of money in and out of a business. Cash flow statements help businesses understand how well they are managing their cash, ensuring they have enough liquidity to cover expenses, make investments, and sustain operations. Once we've covered these financial statements, we'll introduce ratio analysis, a method used to interpret and compare financial data. Ratio analysis allows businesses to measure their performance, efficiency, and financial health by comparing different elements of their financial statements. These ratios are often used by investors, creditors, and management teams to make decisions.
Finally, we'll wrap up with a conclusion, summarizing key takeaways and reinforcing the importance of accounting in the business world. By the end of this workshop, you'll have a strong understanding of how businesses track, analyze, and interpret their financial data to make strategic decisions. Accounting is essentially the backbone of any business, acting as a structured system that tracks finances as they move through an organization. It allows businesses to gain valuable insights into their financial health by identifying which strategies are yielding positive results and which ones may need adjustment. This process is essential for companies aiming to refine their operations and maximize profitability. Beyond just tracking numbers, accounting plays a significant role in financial planning. By analyzing past trends and understanding current financial standing, businesses can develop well-informed strategies for future growth, budgeting, and investment opportunities.
There are four main types of accounting. Each serves a unique function within the business. Financial accounting is responsible for documenting financial interactions and exchanges, usually for the purpose of generating final reports like balance sheets and income statements. These reports are usually shared with external parties, such as investors and regulators, to provide transparency regarding a company's financial health. Managerial accounting, on the other hand, takes these financial reports and applies them to internal decision making. By interpreting financial data, business leaders can evaluate their company's performance and make choices to enhance efficiency and profitability.
Another key area of accounting is cost accounting, which focuses on tracking and managing overall costs within a business. By analyzing expenses, companies can determine pricing strategies, budgeting plans, and cost efficiency improvements. Lastly, tax accounting is dedicated to ensuring proper documentation of taxes, ensuring compliance with government regulations, while also identifying potential tax saving opportunities. Together, these four types of accounting work to maintain a business's financial stability and long term success.
Now let's dive into the balance sheet, one of the most essential financial statements used in accounting. The balance sheet provides a snapshot of a company's financial position at a specific point in time, detailing what a business owns, what it owes, and the remaining value for its owners or shareholders. It is a crucial tool for assessing a company's financial stability and is often used by investors, creditors, and management to make informed business decisions.
At the core of the balance sheet is a fundamental equation. Assets equal liabilities plus equity. This equation must always hold true, as it represents the financial structure of any business. Now let's break down each of these components. Assets refer to anything of monetary value that a business owns. These can include physical items like cash, inventory, real estate, and equipment, as well as intangible assets such as patents or trademarks. Assets are what enable a company to operate and grow, making them a key factor in determining a business's financial strength.
On the other hand, liabilities are financial obligations that a company must pay, such as loans, outstanding bills, or any other debts owed to outside parties. High liabilities can sometimes indicate financial risk, as they may hinder a company's ability to invest in growth or take on new opportunities. However, if managed properly, liabilities can also be used strategically to expand a business.
Lastly, equity represents the ownership value in a company. This includes investments made by shareholders, retained earnings, and any financial programs contributing to the company's net worth. Essentially, equity is what remains after all liabilities have been deducted from a company's total assets, making it a key measure of a business's value.
The balance sheet equation must always balance. If the total assets do not equal the sum of liabilities and equity, this could indicate errors in data entry, miscalculations, or even financial discrepancies that need to be investigated. Ensuring the accuracy of a balance sheet is crucial for making sound financial decisions and maintaining transparency in a business.
Understanding the importance of a balance sheet is key to recognizing how businesses use it to make informed decisions. This financial statement plays a vital role in shaping a company's strategy by providing insights into financial health, stability, and risk. One of the primary uses of a balance sheet is assessing risk. Companies can evaluate their liabilities and determine if they're taking on too much debt or if they have enough assets to cover their obligations. This helps businesses make smart decisions about future investments and financial planning.
Balance sheet is also crucial for acquiring loans. When businesses seek financial assistance from banks or investors, leaders often review their balance sheet to assess creditworthiness. A strong balance sheet with a healthy ratio of assets to liabilities increases the chance of securing funding, while a weak balance sheet may signal financial instability. Additionally, businesses use balance sheets to solve other financial ratios, such as liquidity ratios, debt to equity ratios, and profitability ratios, which help measure overall financial performance and sustainability.
Another key benefit of maintaining an accurate balance sheet is implementing transparency between employees. In publicly traded companies or even private companies, financial transparency fosters trust among stakeholders. Employees, investors, and business partners can all gain confidence in a company's financial standing when they have access to clear and accurate reports.
However, there are certain restrictions to balance sheets that should be considered. Since they capture financial data at a specific point in time, they do not reflect long-term trends or day-to-day fluctuations. This means a company's financial position could appear strong on paper at one moment, but change significantly shortly after. Additionally, some companies may choose to include or omit certain data to manipulate their financial reports in a way that favors their overall trend, potentially misleading investors and stakeholders. Another limitation is that a balance sheet does not capture more personal aspects of a company, such as workplace culture, employee satisfaction, or external market trends, all of which contribute to a business's long-term success but are not directly reflected in financial statements.
When it comes to a balance sheet formation, the process depends on the size and structure of the company. In smaller private businesses, balance sheets are often created by the owner or an internal accountant. However, in larger public companies, professional accountants or external auditors are typically responsible for preparing and verifying these financial statements to ensure compliance with regulations. The frequency of balance sheet reporting also varies. Some companies generate them annually, quarterly, or monthly, while others, particularly those in higher transaction volumes, may even update them on a daily basis.
Now that we understand the structure and importance of a balance sheet, let's take a look at an example to see how everything comes together. As you can see, the balance sheet is divided into three main sections: assets, liabilities, and shareholders' equity. Each of these sections is further broken down into smaller subsections that provide more detailed insights into a company's financial standing.
Starting with the assets section, we can see that it includes both current assets such as cash, accounts receivable, and inventory, and non-current assets, which may include property, equipment, and long-term investments. These are the resources that a company owns that contribute to its operations and growth. Moving on to liabilities, this section details the company's financial obligations. It is typically split into current liabilities like short-term debts and accounts payable, and long-term liabilities such as loans or bonds payable over an extended period.
The final section, shareholders' equity, represents the value that belongs to the company's owners after all liabilities have been accounted for. This can include common stock, retained earnings, and additional paid-in capital. One of the most important things to notice is that the total assets equal the total of liabilities and shareholders' equity. In this example, both sides of the equation balance, with amounts like $323,888 and $338,516, ensuring that the financial records are accurate and properly reported. If these numbers did not match, it could indicate errors or discrepancies that need to be investigated.
Another key detail to observe is that balance sheets are always dated, as they provide a financial snapshot of a company at a specific point in time. This helps businesses, investors, and lenders analyze financial trends over different periods and make informed decisions based on the most recent data.
Now, let's move on to the income statement, another key financial document that businesses use to track their financial performance. Unlike the balance sheet, which provides a snapshot of a company's financial position at a specific moment in time, the income statement records financial activity over a period of time, such as a month, quarter, or a year.
The income statement focuses on three major components: revenue, expenses, and profit, which are gains and losses. It details how much money a company has earned, how much it has spent, and what remains as a profit after all expenses have been deducted. It makes it one of the three most essential financial statements, alongside the balance sheet and cash flow statement, that businesses rely on to evaluate performance and make strategic decisions.
A key figure on the income statement is net income, which represents the company's profit after all expenses, including taxes, have been deducted. This is essentially the bottom line, showing whether a company is operating at a profit or a loss. Positive net income means the business is making money, while a negative net income indicates financial challenges that may require adjustments.
Another important metric found on the income statement is earnings per share, or EPS. This figure represents the portion of profit allocated to each share of stock in the company. Investors closely monitor EPS because it provides insight into a company's profitability and potential for future growth. A higher EPS typically signals stronger financial performance, making a company more attractive to investors.
Since the income statement tracks financial performance over time, it helps businesses analyze trends, assess the impact of financial decisions, and make necessary adjustments to increase profitability. It's a critical tool for management, investors, and other stakeholders who need a clear picture of how well a company is performing in generating revenue and controlling costs.
Let's take a deeper dive into the income statement by examining two key areas: operating versus non operating revenue, and the difference between single step and multi step income statements. First, let's talk about operating versus non operating revenue. Operating revenue refers to the money a company earns from its primary source of income. Think about the core activities of the business, like sales of products or services. This is the revenue that directly reflects the company's ability to generate income through its main business operations.
On the other hand, non-operating revenue comes from the secondary sources. These could include things like investment income, interest, or gains from selling assets. While these sources of income are important, they don't directly relate to the company's main business activities. Understanding the difference between these two can help companies identify which areas are truly driving profitability and which areas might need adjustment.
Now let's move on to the structure of income statements. There are two main types: single step and multi step. A single step income statement is pretty straightforward. It adds up the total revenue and gains and subtracts the total expenses and losses. This simple calculation provides a quick view of a company's profitability. However, it does not offer a detailed breakdown of multiple types of expenses or revenue.
A multiple step income statement, on the other hand, takes a more complex approach. It breaks down the income and expenses into categories like gross profit, operating income, and pre-tax income, before arriving at the final after-tax profit. This approach provides a more detailed and realistic view of a company's financial progress, helping businesses analyze how well they're managing core operations versus other factors like taxes or interest expenses.
So the structure you choose depends on how much detail you want to present and the level of insight you need for decision making. Multiple step statements can offer a clearer picture of a company's operational success, while single step statements provide a simpler overview.
Now, let's look at an example of an income statement to see how all the concepts we've discussed come to life in a real-world scenario. In this example, we can clearly see key sections like revenue, income, net income, and earnings per share. These are the main components that show us the financial performance of the company over a given period.
Notice how many of these sections are further broken down into smaller subsections. For example, under revenue, you may see different types of revenue, like product sales or service income, while under income, you might find operating income and non-operating income. These detailed subsections help businesses and investors understand where the money is coming from and where it's being spent.
One important thing to highlight is that the time span listed on the income statement is typically by year, not a specific date. This gives us a more comprehensive view of a company's financial performance over a set period, rather than just a snapshot of a single moment in time, like we see on the balance sheet. As you can see, income statements are organized to provide a clear picture of how well a company is performing and where they stand in terms of profitability. By breaking down these sections, businesses can identify areas that need improvement and track their progress towards financial goals.
Now let's move on to cash flow statement, which is another critical financial document. Unlike the income statement, which measures profit, the cash flow statement focuses on tracking the actual movement of cash in and out of a company. The cash flow equation is simple. Cash flow equals the total cash inflow minus the total cash outflow. This means that we're looking at the money that's coming into the business through the revenue, as well as the money going out of the business due to expenses.
Revenue is considered the inflow, while expenses are the outflow. The cash flow statement goes beyond just showing profits, focusing on how cash is being utilized within the business, which is vital for understanding company's liquidity and ability to fund its operations, pay debts, and invest in growth.
At the bottom of the cash flow statement, you'll see a net increase or decrease in the cash and cash equivalents, or CCE. This is a key figure as it shows how much cash the company has gained or lost during the period. Lastly, cash and cash equivalents are the most liquid assets a company holds at any given time. These are the assets that can be quickly converted into cash, making them essential for day-to-day operations and ensuring the company has enough liquidity to cover immediate expenses.
Now that we understand cash flow, let's break it down into different types and how they connect in financial analysis. Cash flow is categorized into three main types: operating, investing, and financing. First, we have cash flow from operations, CFO, which comes from production and sales. This represents the cash a company generates from its core business activities, things like revenue from sales and payments for expenses.
Next is cash flow from investing, or CFI, which includes transactions involving assets and securities. This could mean purchasing new equipment, investing in stocks, or selling long-term assets. Then there's cash flow from financing, or CFF, which deals with a company's financial structure, like issuing debt or equity, repurchasing shares, or paying dividends into shareholders.
All of these cash flow types contribute to free cash flow, or FCF, which represents the cash available after covering operating and capital expenses. This is a key indicator of company's financial health. From FCF, we derive operating cash flow, or OCF, which measures how well a company's day-to-day operations generate cash.
Finally, these cash flow figures help us analyze a company's financial standing using key ratios like the current liability coverage ratio, which measures how well a company can cover short-term debts with its operational cash flow, and the price to money flow ratio, which compares a company's stock price to its cash flow per share.
In short, understanding these different cash flow types allows businesses and investors to assess financial stability, profitability, and investment potential. Now let's look at real examples of cash flow statements and how they're structured. Notice how the statement is divided into three main sections: operating cash flow, financing cash flow, and investing cash flow. Each of these sections is further broken down into smaller subsections, detailing specific cash inflows and outflows.
At the bottom, we see key figures like net cash, which represents the overall cash movement during the period, and CCE, which is cash and cash equivalents, which reflects the company's available liquid assets. Another important figure is the bottom line, which shows the net increase or decrease in cash flow over the given period. Unlike income statements that often focus on specific dates, cash flow statements typically summarize activity over a yearly time span.
By analyzing these sections, businesses and investors can track how cash is moving through a company and evaluate its financial health. Now that we've covered cash flow, let's dive into ratio analysis, a critical tool used to evaluate companies' financial health and efficiency. Ratio analysis takes different aspects of a financial statement and uses them to assess overall company well-being. It helps businesses, investors, and analysts determine a company's strengths, weaknesses, and financial stability over time. By examining different financial ratios, we can gain insight into how well a company is performing, whether it's growing, and if it can sustain operations in the long run.
On the screen, you can see the six main categories of financial ratios: liquidity, solvency, profitability, efficiency, coverage, and market prospect ratios. Each of these has sub-ratio sets that further break down specific financial aspects of a company. Liquidity ratios focus on how well a company can meet its short-term obligations, ensuring it has enough assets to cover debts. Solvency ratios take a broader look at financial stability by analyzing long-term debt levels and how much of a company's financial financing comes from borrowed funds versus investor equity. Profitability ratios measure how efficiently a company generates earnings relative to its revenue, assets, or equity, helping assess whether the business model is financially sustainable.
Efficiency ratios analyze how effectively a company utilizes its resources to generate revenue. A company that operates efficiently can produce more with fewer resources, making these ratios key for measuring productivity and cost effectiveness. Coverage ratios determine a company's ability to meet financial obligations, particularly when it comes to paying interest on debts, which is crucial for assessing financial risk. Lastly, market prospect ratios are used by investors to evaluate a company's future growth potential and stock value. These ratios, such as the price to earning ratio and dividend yield, help determine whether a stock is overvalued or a good investment opportunity.
All these ratios play a vital role in measuring a company's growth or decline over time. By consistently analyzing these financial indicators, businesses can make informed decisions on budgeting, investing, and expansion, while investors use them to evaluate the risks and rewards of investing in a particular company. This makes ratio analysis one of the most important tools in financial decision making.
To wrap up, accounting is a vast and interconnected field that plays a crucial role in business, economics, finance, and many other industries. It provides the foundation for financial decision making, helping companies assess their performance, manage resources, and plan for the future. Whether it's through financial statements, cash flow analysis, or ratio evaluations, accounting serves as a powerful tool for understanding and improving financial health.
Even having a basic understanding of accounting can be incredibly valuable, not just for businesses, but also on a personal level. It can help with budgeting, managing expenses, and making informed financial decisions. Additionally, it allows individuals to better understand economic trends and patterns, giving insight into the broader financial landscape. With accounting knowledge, you can gain a clear picture of how money moves both within organizations and across the global economy.
To explore more topics of the business world, we highly encourage you to take a look at the resources linked in the description box. Make sure to check out other programs under Next to Business, such as Boost, which is our recorded workshop program where we present a wide span of business topics like this video. 2 workshops will be posted on YouTube monthly. And Echo is our podcast, where we invite guest speakers who are industry professionals with years of expertise to talk about their personal experiences and offer insight to younger listeners. New episodes are out each month on our YouTube channel.